Hello, welcome to Principles of Macroeconomics. This is lecture 3, and today we're gonna talk about system of macroeconomic indicators. I'm gonna introduce you to list of indicators that we actually gonna study all the way up to last 2 weeks when we study financial systems. So it's majority of the course we're gonna go through each of the indicators that I'm going to talk today in detail, but I'd like to show you a big picture of those indicators for you to understand kind of an outline of the course. So again, download slides from Lima, lecture 3. There is just one slide, it's a list of indicators, but it's still helpful to see them all in once. So we have in the economy 3 sectors. It's a real sector, what is related to goods and services. It's called real just basically because we can see those things and touch them, so it's very physical definition of real. And services probably we don't usually touch, but it's still something that we can understand that it exists. Financial sector is a supportive sector which supports the real sector with the financial flows, particularly money market where we have loans and deposits respectively, and the capital market where we have stocks and bonds, and that we're gonna leave it for the end of the course and study that as well in a bit. So the real sector is the fundamental part of the economy, that's the basis of the economy, even though in modern days financial sector actually dominates the industrial production. It dominates, does not dominate the entire real sector, but it dominates each of the part of those real sectors. So real sector consists of production and trade. If you imagine US economy, which basically entirely represented by GDP, and you see a GDP breakdown, that's what we're gonna do again later in the course, we will see that around 40% of the economy is trade. So trade is quite important and actually is the majority of economy, but it's just an operation of transferring goods from producers to consumers. So in terms of macroeconomy, it's not that interesting. Again, looking back to the first lecture when I said that we need competitive markets. So in terms of trade, we need competitive markets and a competitive trade. So luckily we have in the United States here quite competitive trade with different vendors and now internet. It's all relatively competitive. So we are, aside of being competitive, we are not interested. Oh gosh, this cat is very distractive. But sorry about that. So we don't talk about trade, internal trade, I mean retail trade, wholesale trade. We don't talk about in this course because it's not that problematic and kind of interesting, even though that's a majority of our economy. We will talk about international trade because it's problematic, and there are a lot of issues related to that, but that's not a part of this discussion currently. So what we will focus first is on production and income. Those are 2 indicators where we start our analysis, how much money people make and how many things are produced in the economy. Industrial production is measured by IP index, or industrial production index. We're gonna talk about that. And household income, it's basically an income of a family. That's an indicator we measure income. Next you can see is inflation. I'm not sure if you heard about it, but that's quite a common term. You might hear in the news quite a lot. And inflation is basically a price increase. So we have a certain level of prices which is calculated by, there are a lot of efforts into imagining the typical American citizen and its consumption basket. So the federal government has a designated statistical bureau that try to mostly accurately find out what a typical American citizen buys. Then they create this basket of things and calculate the prices of those things and estimate the price growth for those things, so for that basket. It's all transparent. You can see what is in the basket. If you're interested, you can go to Bureau of Statistics and see a breakdown of the index and what is growing, what is not. So it is more or less transparent, but it is very questionable indicator because first of things related, which is a recent trend, I should say. 30 years ago, there were no such misbalance, but what we have now is a huge lean of expenses related to rent or mortgage loans, depending how your housing is, but it's housing expenses and education and healthcare expenses. Traditionally, those things were not that pricey in terms of this basket. And they're very hard to calculate because if you're a student, it's probably majority of your expenses go to education. But when you finish education, you don't pay for it unless you have a loan, then you kind of pay later. But from a perspective of average citizen, it's very difficult to identify what budget share the education goes. The same with healthcare. If you're a senior citizen, you probably spend more on healthcare, and again, it depends on quality of each individual health. Those expenses are calculated. So it's all very difficult now. It's way easier to calculate the price of apple and cheese and cars, but with stuff like healthcare and education, it's quite problematic. And that's why inflation indicator gets a lot of criticism now, because in recent 10 years it's very low. We actually have very low inflation, lower than our target, and a bunch of problems related to that. But at the same time, people feel, huge parts of population feel that their expense is growing way faster than zero. Basically, they're actually growing faster, and so the inflation does not represent the real price growth for part of population. So that's a problem and kind of outline, but we will stick as its introductory level. We'll try just to understand what we have, and we have the measured inflation. You can see in brackets is CPI. It's Consumer Price Index. That's the most common measure of inflation. So it's from a consumer perspective. There is another index called PPI, which is Producer Price Index, and that is used for business. So if you're a corporate owner of corporation or CEO of corporation, the price level you face is quite different from a consumer. You don't buy groceries that often or pay rent. Usually you buy raw materials, you buy electricity, And so you face a different goods structure. That's why we have two indexes. One is for consumers, the most popular, but if you analyze business, you need to use something appropriate, which is PPI. Moving forward, we have CAPEX and FDI. So that's quite a fancy abbreviation, but it just stands for capital expenditures. So CAPEX is capital expenditures. What is capital expenditures? It is basically an aggregated investment of all the companies in the country. As companies report tax statistics, we can get that, so they're obligated to report the financial statements, at least large corporations, and so that's how it's collected. And it is very important from a macroeconomic perspective because investments generate our future success. So right now, investments is kind of cost, right? If you can see, in your own example, if you spend money on education, you basically invest in education. It's not like you consume education like an apple. You spend money on apple, you eat an apple, that's gone. But with education, it's more of investment. You invest in your education and then you expect and hopefully will get a better job if you would not have education. So for companies, it's similar. They invest in development and aggregated those investments can tell us about the future perspective of a country. So if we invest a lot, there is a high chance. So again, it's not definite. We might have bad strategies. Some business might not work out. But on aggregated level, there is a high probability that we will have successful next period in the economy. Now, there is a problem with this logic related to recent probably 15-20 years with the rise of IT companies, because these expenditures and investments explain very well how manufacturing companies work. So if manufacturing company invest a lot, they usually increase manufacturing or increase quality, and they actually have increase in production. But with IT industry, it doesn't really work like that, because you need a successful idea, and companies like Google, Apple, Microsoft, they do not invest that much in actually expenditure. They buy other companies, that's what they do mostly, but it's not count as capital expenditure because you do not expand. You just buy another company that already exists. So you expand your company, but you do not expand the business itself. Aggregated, you do not develop something new, you just bought another company. It's more on financial side. And for those IT companies, they don't need that much money, so they might invest less, but way more efficient. And so it's quite disruptive in recent years to follow this indicator. And now predictions are not that clear. And that's why it is substituted with, well, maybe used parallel, but in some countries like South Korea specifically, they like to use it. They use R&D. So there is research and development investments. Maybe you've heard this term. R&D is very popular. Don't mix it with R&B. That's something different. So research and development, that's budget, usually a state budget, or at least heavily related to state. And IT companies invest a lot. Some investors specifically target R&D. So aggregated R&D investments can tell us now better than capital expenditure about future success. There is a belief that if we invest in research, we invest in new ideas, more, then we'll be successful in next economic period. But again, it's even more riskier because when you invest in research, statistically, actually 90% of research has no business benefit. It's not transferable to business. But the 10% actually is extremely successful and covers the cost of entire investment. So it doesn't mean if 90% is a failure, it doesn't mean that overall is a failure, because 10% actually returns on those 10% are extremely high and valuable and covers the cost of all the budget. And so overall it works, but it's not very precise. So the fact that we increase R&D, let's say we double our R&D expenditure this year, we might get a success, but first it's not very definite. The probability of that is kind of, I mean, it's high, but it's not definite. It's not 90% or 99%. It's more of like 70%, which is not very precise measure. And another thing with investments, you can see it's FDI. FDI stands for foreign direct investments. That is particularly important for developing countries. And for developed countries, it's hard it's also important, but it's hard to track because developed countries invest a lot and receive a lot of investment. So you need actually a breakdown of those two flows and like play a lot with the statistics to understand whether it's beneficial or not. But it is one of the major indicators for developing countries, probably number one indicator of future success. So when we look at the overall indicators, we put most value not on those that explain what have been going before or what is going on now, but those that can tell us about the future. And so household income seems like the most important thing. That's how much money we all make. But it's very bad in explaining what's going on in the future. It's kind of good statistic to tell what was in the economy in the particular period, maybe what's going on now. If we take the income growth compared to previous time, if we have now more money, that we are likely to spend more, invest more. But it's very short term. It's very poor predictor of future of the country. So we look more on investments and employment as well, and interest rates. So we look more on the indicators that are maybe not that important or sounds that important, but they have ability to predict future. And so foreign direct investments for US might be not really important, but for developing countries it's really number one, because they don't have capital for R&D or capex. They don't have enough capital to develop themselves. And so what they rely on is a foreign capital, that is FDI, the capital that brought from developed countries to build new factories or to develop the country. And the higher the FDI, the higher the chances of future success of developing country. And that's very important to know. So if your future career is related to developing countries, particularly smaller development countries, because countries like China, they're still developing, but they're very huge and kind of rich already, China and India. So for them, it might not be that important, but countries like Brazil, Indonesia, Philippines, Thailand, Eastern European countries like Poland, Ukraine, for those countries, that's the key. And again, entire Africa and Latin America, those countries as well. That's the major thing. If you have drop in FDI, probably experience significant problems, and if you have increase in FDI, you will more likely to see success, economic success of the country. So even though for US it's not that relevant, we still have to know about this thing as foreign direct investments. Next one is unemployment. It's quite easy to understand what is unemployment. So it's percentage of people that are unemployed. We'll talk about the exact calculations and basically problems with that calculations, but it's very intuitive. And it is also intuitive that if you have high unemployment, a lot of people out of jobs, you will have certain instability. If you don't have a job and you are poor, so you don't have any wealth to support your basic needs, it always turns into political protest because there is no way, everyone needs food and basic things. So if they don't have it, they go to riots. That's why unemployment is not just, like a number or another category in this list. That's a very special thing because that's what is the goal of the government, primary goal. You might see, GDP and income and investments, all those are desirable, but the fundamental thing that holds us, stable is certain level of employment. Or it's also combined with unemployment benefits. That's why even in the United States, which tends to be less social supportive compared to other developed countries. So if you're unemployed in Europe or Japan or Australia, you're way better off than if you're unemployed in the United States. But if you're employed, you are better off in the United States. So that's a trade-off. So don't think that other countries are always better. No, it's a trade-off. And that's not just randomly. It's a strategy specifically in Europe. That's a strategy. As society, they decide, okay, I will give away part of my income when I am employed to the unemployed people because first I want them to be employed at some point of time so they can get some new skills, or I can be unemployed and I want that security for myself. So that's a vision typical in Europe. In the United States, the vision typical is different. You want money, you work, you don't work, you're lazy. So it's hard to judge actually what is right or wrong. First one looks good, but there are a lot of cases of demotivation of people to work. That is also true in Europe. While in US it's a bit harsh, but there is probably no problem with motivation to work because as you're unemployed, your benefits are extremely low and you live like in a third world. So that's quite a problem. But on the other hand, that really motivates you to work. So we're going to discuss more about all these problems. But what I want you to understand in this point is that unemployment is really a fundamental goal of the government. I mean, employment or low unemployment rate, because that's what politics about it, support people. And if that doesn't work, the problems appear. So it's a very politicized issue. And now luckily we are good with a low level of unemployment here in the United States, but we will talk about other things that are problematic related to that indicator. And next one is GDP. Finally, I already mentioned quite a lot. You might even don't know at this point what it is, but I hope you heard it because that's the main indicator in terms of policy debates. from the news, they always say GDP is growing or GDP is not growing, and that's good when it's growing. So what it is, it's a gross domestic product. The name doesn't tell you probably much, so we just call it GDP. It's no need to actually memorize it. That is gross domestic product, because it doesn't tell you much. So if FDI, it's a foreign direct investments, that helps you to understand what it is. It's foreign direct investments. Gross domestic product, so we call it GDP, and what it is basically the amount of goods produced in the country for a certain period of time. Usually we talk about years. So GDP is reported quarterly, but we use annual data to do any decisions, because each quarter is so different because of the seasons and because of time of reporting. Some companies do not report what they produce immediately, so quarterly data kind of messy. So we use annual data. Annual data, that's 1 year. What is produced within the country for 1 year. Now, it's not like industrial production, because it's all the companies, what they did. So trade is included there, government is included there, everything, banks included there. And the way it's calculated is based on the concept of value added. So value added concept is the key to understand GDP. Just heads up for future, I will not talk about it for now, because we'll have a separate lecture on GDP. But just to give you a heads up, so it's an indicator of the entire economy of what was produced. It has a lot of issues, around 10 issues, and the book that is assigned to this class as you're reading, it's not a textbook, a specific book about flaws of GDP, because that's very important. We use GDP as our main indicator. That's all in the news. GDP is growing, we want GDP to grow, and that's why that particular book is important, to show why it's wrong, because it's a good indicator to measure production, but the production doesn't help us with many problems that we have. And partially, and to a large extent, we have those problems because we rely only on GDP in our economic decisions. And so we ignore things that are indifferent to GDP or even negative to GDP, but very positive for quality of life. And that's a big issue internationally, and specifically in the United States, because other countries work towards more balanced indicators for quite a long time. And the indicator of that is that book is actually was promoted or kind of ordered by the president of France, Nicolas Sarkozy, back in 2010. So it was president of France who raised that issue and asked Nobel laureates Joseph Stiglitz, Amartya Sen, and French economist Jean-Paul Fitoussi to see on this issue, to discuss why GDP is not reflecting quality of life and how we can deal with that. And you're gonna write a special essay on that. I'm gonna get to that. It's a part of your homework, but that's way ahead, so don't worry about that for now. But get a book too, because you need time to read it. Last one in the real sector is trade balance. So trade balance is export minus import. So if it's positive when our export is higher than import, and it's negative when our import is higher than our export. One of the first economic ideas that is around 500 years old is that your export should be higher than your import. And it's fascinating, but it's actually true. And now with all the new developments, we updated that it should be a little bit high. So if your export is really much higher than your import, you still are subject to problems and potential crisis. But if your import, so what you want is your export is just slightly higher, 5% higher, maybe 10% higher, but not 50% higher. So around 5–10%, that would be optimal. Or even 1% is better than negative. So you want export to be positive, trade balance to be positive, so export higher than import. And because if your import is higher than your export, you will have eventually a crisis, especially if the gap is quite large. Now, to illustrate that idea, there was quite a substantial statistical research, and it showed that if the difference is 10% or more, in any country, anytime, you will guarantee to have a major economic crisis. So if your import is higher than your export by 10%, even in 1 year, you basically guarantee a crisis. But 1 year you can escape if there is sudden, natural disaster or sudden shocks. But if it's a constant economic system for 2–3 years or longer, you will collapse. The economy will collapse. The only exception from that is recent 20 years of United States trade. We don't have, I think, 10%. We have a lower deficit, but it's very constant because we have it along an extremely long period of time. And so for us, it's particularly important to see why it's happening, why it's not hurting the United States as economic theory predicts, and why we talk about trade so much. And also we have these very aggressive comments in the news that we are losing to China or Mexico, that someone abuses the United States in trade. And they're so misleading and wrong from economic point of view that we really need to discuss it, even though it's maybe more for upper level course. But if it's the only macroeconomic course you take, I want you to be clear on issues of trade, because they are very important and very misleading from the TV perspective. Just a heads up, if you go to Walmart and you buy an apple juice, you are not abusing Walmart, and Walmart is not abusing you. So trade is a voluntary transaction without winners and losers. So when we say we trade with China and we are losing it, that just doesn't make any sense. We do have a trade deficit. That's a different problem, and we'll get to that, who is losing and who is winning. But it's not United States is losing and China is winning, or China is winning and US is losing. It's different people and different institutions are within United States are winning and losing, and same within China. And that's how it is. But trade, the same as you buy anything you want, you do it voluntary and you don't really abuse another party and they don't abuse you. It's a voluntary natural transaction, because we are not in the dictatorship where someone orders you to buy something for a certain price. Luckily, we in more or less free, especially international trade. No one forces United States to buy anything. Come on, that's United States. Maybe someone forces some, small African country from a neighbors to buy something because they have some political and even military power over them, that such thing possibly happen. But talking about China and US, no one could enforce anything here because both countries are very large and very powerful, and even smaller countries have quite a lot of freedom in trade because you can trade with anybody you want. So if you don't like particularly one country, you can buy same things from another country. In most cases that's possible. And so just for now, realize that trade is neutral in terms of winners and losers. That's all just politics. But we do have a problem with a trade deficit, and we'll see who is creating it and who is winning and losing within the United States, because that's indeed where the problem is. One party, certain parties in the United States are winning a lot while other parties are losing. But it's not war between the countries, it's a conflict of interest within the country. Now moving to financial sector, we have interest rates, we have exchange rates. Those are the main indicators we look at when we try to understand what's going on with financial sector. Now we have also bank statistic, which loans and deposits, that's a quite obvious indicators. The more loans we have, the more risk we have in the country. The more deposits we have, the more capital we have for those investments, particularly that we talk about. So deposits are good, loans are bad in a simple vision, but not always. Some loans are productive. So again, if you take a student loan and you study responsibly, that is an investment. So that might actually pay off, and hopefully will pay off for all of you with a high return. So actually investments in education prove to be one of the highest, with the highest return out of all investments. So there is a great chance that you will pay off your student loans if you have any and be successful. But what we focus on is interest rates and exchange rates, because that relates a lot to the real sector and shows a lot of overall economic balance. But those things are quite complicated, so I won't get into details now. Just wait for the specific lectures on each of them. And the last one is budget deficits and public debt, which characterize the government sector. So what the government does is collecting our money using taxes and spending those money on certain things. Now, it used to be, and certain countries still stick to that, particularly Germany, believes in what's called austerity, if you heard that word, but basically it means balanced budget. So how much money you collect, the same amount you spend, and you don't borrow, you don't create a public debt. This logic actually proved to be wrong, because the government investments are so important, and at the same time government borrowings are so low risk that now the majority of economists believe that it's fine that there is certain deficit. Problem is the amount of deficit. So if we have too much deficit, the deficit is too high, we might end up in crisis. And that's one of the issues with the United States, because it's going up quite for a while, and it is a source of concerns. Specifically public debt, because again we accumulate. Public debt is accumulation of budget deficit over time. So if you have budget deficit in certain years, and then you have a balanced budget or neutral or positive surplus, then you can balance out and reduce your public debt. usually you reduce actually your public debt relative to the size of economy. So the good thing with all loans, and same with the government loan, that if you borrow, you borrowed 10 years ago and you need to repay now the same, let's say you borrowed $10,000 10 years ago and you need to return those $10,000 right now, and government borrows on a very friendly interest rate, which was zero for almost up to this year. So it's exactly like this. You borrow $10,000 and now you return $10,000 with a zero interest rate, maybe 0.2, very low. But the economy has grown, so now that $10,000 are not that, in terms of purchasing power, are way less than actually you borrowed. And so in general, government never have this surplus, but what they can have is a balanced budget which allows them to repay the previous debt with a basically new economy and a higher level of growth. And so what we care about is a relative public debt to GDP. So we have debt compared to GDP, and that's what we are looking at. And we're going to talk about that in detail as well when we get to there. So below you can see sources of those statistics. We have Statistic Bureau in the United States, which is called BEA, Bureau of Economic something. I don't even recall. Bureau of Economic Analysis, I guess. But it's known as BEA. Then we have for financial sector, it's Federal Reserve System, FRS or Fed. It is the central bank of United States. In other countries, usually you go like Bank of Japan or Bank of England. So it's a central bank of a country. European Central Bank for European countries, but each country also has like Bank of Italy. So there are two layers in that structure. And if you're interested in government statistics, you go to Ministry of Finance, or in United States it's called Department of Treasury. In other countries it's called Ministry of Finance. And finally, you can see we have secondary indicators, which are stock market indices, credit ratings. Those things help us again with the prediction. They are not very informative in terms of economic situation actually, compared to real macroeconomic indicators that we just went through. Those things like investments, income, inflation, they really represent certain characteristic, while stock market index is not reflecting, any type of well-being of the economy. But the benefit of those things that they change, every minute now during the trading day. So they absorb certain shocks very fast. And if you're considering forecasting economic situation and you care about what's going to be in future, it's very important to consider those like stock market indexes, because they absorb information faster, and so you can adjust your prediction also faster. And again, GDP goes, the first estimation goes maybe 1 quarter later, even more than that, but that estimation usually so imprecise. So you wait for a second estimation, which goes more than half year after the fact. So that's half year lost basically in terms of economic activity. You need to wait half year to know what's have been half year ago. That's very long time in the economy. And stock market updates daily. So if there is certain rumors, if there is some problems with the production or problems with income, or whatever happens, stock market usually reacts. It just sometimes it doesn't react correctly, or is too optimistic, too pessimistic. But at least when you see a shock, if you're a macroeconomist, that's actually what I was doing when I was working partly. So I was looking at macro statistic, but I also looking how stock market reacts to news and something, if there is something going on in the stock market which is not related to macroeconomy, that's a sign that we are missing something, but there is certain expectations. So you need to dig in and figure out what's going on, who believes in what. And in this case, it's quite helpful. So we're gonna stop here and continue with the next lecture later.